Do you think the market's going to kind of be range bound? Give us a little bit more direction when you say range bound. Right now, we're seeing the markets above 4,000. They've held pretty steady above 4,000. At one point this year, they were down to about 3,860. Are we going to dip back to that 3,860 or stay closer to this 4,000 range?
I think maybe dip down to 3,860. So I've actually been on this whole range bound bandwagon pretty much since last June. So since last June, I thought, there's a lot of stuff that's gone on, a lot of information that needs to be consolidated, and that simply takes time to get through it. So we've moved, and it's interesting actually, if you look at that range bound since June to now, you see the range consolidating, which actually makes me feel pretty good. And you all know I'm no technician, but I think what it really says from a fundamental perspective is that we have digested a ton of information. And it's interesting because I was having an argument/debate with my partner Greg the other day. And he said, look, I can make a really bullish case for the market, and went through all the things that could go right, which is earnings start to improve. China continues to reopen. We know where interest rates are going. We know that they're probably not going up too much more from here. And went through this whole list. And I said to him, OK, but what does that get you to? $240 earnings? Even if you stretch and put an 18 times multiple on $240 earnings for next year, you're still at only about 41.50, which is only about 7% upside. So I think the upside is really capped, and there's still a lot of difficult stuff to get through. I think earnings aren't going to be just glossy and rosy from here. I think they're going to be bumpy. And so that's why I'm really committed to this concept of range bound continuing.
Okay.
I think it just continues to be a battle of forces of good and evil.
So I want to bounce something off you. I know you're a big dividend investor. I want to show you something right now. We're looking at the SDOG ETF. This is an ETF that follows the dogs of the Dow strategy over a couple different sectors. It's actually up this week pretty big, outperforming. What do you make of seeing this outperforming in a dividend-focused ETF when so many investors are turning to the bond market for yield, and sometimes higher yield than you can even get from a dividend?
Right. So I think it's interesting because if you look at that SDOG or if you look at DVY or any of the dividend indexes, they actually did really, really well in 2021 and 2022. They held up far better than the broader markets. And then they continued to hold up perfectly fine this year until SVB. And then what you saw was they all tanked, right? And they were down 10% kind of in 3 weeks. As a dividend investor, I got the same spanking that they did, so that stung. And it's interesting because I think you can claim that it has to do with rates, but it really doesn't, because what you saw was as rates were increasing in 2022 into the beginning of this year, they actually continued to hold up. So the real reason that they were down so severely is because, by and large, dividend stocks are frequently energy stocks, regional banking stocks, companies with a lot of leverage, smaller capital stocks, and all of those what got really pummeled in that knee-jerk, fear response following the banking collapses starting starting March 10th. And so what happened now, and the reason we're seeing a recovery, is just that those positions were wildly, wildly oversold. I don't mean the ETFs, I mean the actual stocks that underlie the ETFs were wildly oversold due to nothing wrong with the individual companies, just this response in the market to sell off. Yeah, so I think it's oversold, now being bought back. I don't think it has to do with interest rates.
All right, Jen, we want to bounce a couple of things off you right now. We have some upgrades and downgrades this morning. We're going to start off with Evercore upgrading Walmart, boosting its rating to outperform from inline, also raising its price target to $160 from $145. It cites management's diligent work to pivot Walmart to an omni-channel operation and divestment of non-core assets. What's your take on this upgrade of Walmart?
So we've looked at Walmart many, many times over the years for our disciplined growth strategy and continue to hold off over and over because it's really expensive. We think that the low-end consumer may, if there is a broader economic recession, who's going to get hurt the most? It will be the lower-end consumer. That's where they benefit the most. That's, their main consumer. So we continue to hold off. I haven't read that report yet. Maybe there's something nuanced in there, but every time we've looked at Walmart, we just come away saying too expensive, not enough actual growth.
All right. We've been noting all morning futures in the green, tech's outperformance. What do you make of that? We've had so many disruptions. I know you think things are going to stay range bound, but obviously tech just continues to outperform.
I think it's played out. It's a lot of those stocks, Apple, Amazon, Google, Meta, they're just up. Nvidia, they're up like 30, 60, 80% this year. And there was an interesting thing I heard on CNBC yesterday, which was those stocks on average are up 5% on the year, where on average, or rather, I'm sorry, those stocks are responsible for a 5% gain in the S&P 500, where the S&P 500 was only up yesterday 3.5%, which would imply that they've more than carried the weight. And I look at them and I see valuations that are not that cheap, and I see growth prospects that are not that compelling. So what I think happened, which they were the beneficiaries of the dividend stocks punishment, or anything with leverage or anything small cap, where as soon as things got scary about a month ago, people ran for what had worked for them in the past without really saying, okay, Apple, you're trading at 25 times earnings, but you're only going to produce 6% earnings growth. That doesn't make sense. So I've never thought that those stocks should implode, but I've always thought that they should plateau. Their valuations are stretched relative to their growth prospects.